The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to this edition of Scorebox with Carolyn Roth and myself, Steve Sedgwick, and these are your headlines. President Trump looks to escalate his trade war, promising additional 25% tariffs on imports of cars, drugs and chips. US-Russia talks end with both sides pledging to strengthen cooperation as President Trump hits out at Ukraine's leader over his call to be included in negotiations.
I hear that, they're upset about not having a seat. Well, they've had a seat for 3 years and a long time before that. This could have been settled very easily.
HSBC targets $1.8 billion in cost cuts over 2 years as the new CEO's overhaul takes hold, with Europe's largest lender also announcing a fresh $2 billion buyback. New Zealand's central bank cuts rates by 50 basis points, its third bumper half-point cut in a row, in a bid to boost a flagging economy.
And the UK Chancellor of the Exchequer, Rachel Reeves, faces a fresh challenge with inflation data set to cross the wires in just under 1 hour. CPI forecast to climb to 2.8%. Caro, how are you?
Good, how are you?
Yeah, I'm good. There's an awful lot going on. And I think one thing which is amazingly clear post the Munich Security Conference is I keep hearing European leaders scrambling to come up with a reaction. And you can almost then fill in the gaps after, Fill in, find a reaction to Trump on trade, Trump on Gaza, Trump on Ukraine, Trump on global geopolitical security. And I'm kind of thinking to myself, that is so typically and frustratingly European, because with respect to the volatile policy thoughts towards Donald Trump, the fact of the matter is everything he's done so far was very, very flagged. He hasn't done anything that he hasn't said he was going to do, pretty much, or we could guess he was going to do. So for Europe to only now be scrambling for a reaction on all these different things, from economic policy to geopolitical policy to security policy, I find that frustratingly European. You knew this stuff was going to happen. Why are you scrambling?
Are you accusing the Europeans of dithering? Well, I think that's what they do. That's the European psyche, because there's such a big sort of, the process of consensus building takes forever. Yes. And whether there will ever be a consensus, just go back to the days, just a couple days ago when Olaf Scholz, still German Chancellor, said, hey, it's way too early to talk about the peace building missions. And others say, hey, we need to think about it right now. There's such a big rift and discrepancy between what Meloni is saying in Italy, what Scholz is saying, who's very much a lame duck. Yeah. Will we ever get a consensus on this?
I don't know. And maybe that's a real problem with the European decision-making as well. Maybe it's a problem with ceding certain power to Brussels, but not enough power. Or maybe actually some of that power needs to come back to the sovereign states. But hey, as J.D. Vance says, we have a problem with democracy, apparently. But he's not more worried about Russia. He's more worried about European democracy, yeah. Okay, thank you, Mr. Vance. Anyway, the US president, his boss, Donald Trump, has said he intends to impose further tariffs of around 25% on imports of cars, pharmaceuticals and semi-conductors. Speaking to reporters, Trump said he would make an official announcement and provide more details on April 2nd. Trump also said he's weighing the possibility of further tariff increases on chips and pharmaceutical products over the course of the year. The fresh round of levies comes in addition to separate measures targeting China, steel and aluminium, plus broad global reciprocal tariffs announced last week. Let's take a look at some of the reactions on the equity market as well. And to be honest, again, this is actually kind of going back to my original point about the Europeans reacting as well. These reactions from some of the key stocks that may be affected in Japan and in India, they're kind of moderate. So again, we knew this was going to happen. Ergo, we haven't got 5, 10, 15% falls at this moment.
And you know what has been absolutely fascinating over the course of the last 5 weeks or so since Trump has been in office, and even before that, obviously we had the Trump trade in place before that. Since that, it's been fizzling out. But what you've seen in the market, Steve, and across any asset class, really specifically across equity markets, is a bout of volatility on the day of an announcement, some relief by the end of the day, very much shrugging things off. The equity markets are fine, and why is that? It's because there's no alternative. Tina is still with us. Did you see the Bank of America Fund Managers Index, or the survey yesterday, basically saying investors are taking the most risk in 15 years? Cash levels, the lowest level since 2010. Why is that? Because they don't want to miss out. There's so much FOMO in the market still, because we have those two monster years, 23, 24. Even though policy and politics uncertainty is sky high right now, no one wants to go into cash.
I hear what you're saying. I think there is alternative, and I think there's very good yield on a lot of the bond product out there, actually. But actually, I think equities are still the asset of choice for many people on the back of what we've seen as a very strong earnings season so far as well. We've got more numbers hitting the wires now. We can talk about two companies of CEOs we're going to talk to in a few moments' time, Royal Vopak and indeed Philips as a moment. And don't miss those, because we've got two interviews coming up, which will be great as well. But actually, I think the equities in Europe are still traded at a massive discount, of course, to what we're seeing in the States. So there's a compelling reason to buy there if numbers are okay or even better than that. And in the United States as well, a lot of the US corporates are still knocking the ball out of the park, beating on revenue, beating on net income as well, on EPS as well. And actually, whilst there are concerns about geopolitics, do you buy or sell an equity on the back of it? Well, if the underlying fundamentals of the equity are strong, but you're equally worried about not only geopolitics, but you're also worried about fiscal positions of those governments as well, why wouldn't you buy equities as, wait for it though, equities as the defensive asset of choice rather than actually the more speculative asset of choice?
And that would be bonds.
Well, our bonds,
if you're talking about the deficits down the line.
The deficits are here and they're terrifying.
Well, no one seems to care about them.
They don't.
The big bond sell-off is over.
They don't.
It's February now.
They don't until they do.
They do. Yeah, you're right. Let's push on to the big geopolitical story. U.S. and Russian diplomats agreed to establish a new diplomatic channel and lay the groundwork for future cooperation after talks in Riyadh. U.S. Secretary of State Marco Rubio said he was, quote, convinced that Russia would engage in a serious process to end the war, while Russian Foreign Minister Sergei Lavrov said Moscow would not accept the presence of peacekeeping troops from NATO countries in Ukraine. The head of Russia's direct investment fund told reporters the two countries had discussed economic cooperation, including the potential for joint energy projects in the Arctic. Meantime, President Trump was critical of Ukraine's President Zelenskyy in a Mar-a-Lago press conference, saying it has been a long time since elections were held in the country, and appearing to accuse Ukraine's leadership of being responsible for the war beginning.
Power to end this war. And I think it's going very well. But today I heard, we weren't invited. Well, you've been there for 3 years. You should have ended it 3 years. You should have never started it. You could have made a deal. I could have made a deal for Ukraine that would have given them almost all of the land, everything, almost all of the land, and no people would have been killed, and no city would have been demolished, and not one dome would have been knocked down. But they chose not to do it that way.
And Dan joins us with more from Abu Dhabi. You've been watching the talks, but first let's go back to what Trump has said out in Washington, or Mar-a-Lago rather. These comments are absolutely astonishing. You got to wonder whether it's all concessions towards Russia or any red lines when it comes to Ukraine, Dan.
Indeed, and there are so many moving parts in these talks, but taking a step back here, what we saw unfolding in Saudi Arabia yesterday was certainly a rare moment of dialogue between two geopolitical rivals, and you really have to give credit to Trump for pulling this together after years of diplomatic strain. Those images that we just saw of the US Secretary of State Marco Rubio and the Russian Foreign Minister Sergei Lavrov meeting behind closed doors in what has been described to me today as a positive first step in what's going to be a very long and difficult process. The two sides really agreeing here to establish high-level negotiation teams to explore a possible peace framework, but you do get the sense that this is going to be a slow burn. And my take is, at the end of this, we saw both sides really seeking to manage expectations on a Trump-Putin summit anytime soon. And of course, as you say, Carolyn, these talks are already drawing criticism. President Volodomyr Zelenskyy blasting these discussions. He cancelled his own visit to Saudi Arabia, saying that Ukraine must be part of any negotiations that are determining its future. Of course, European leaders also voicing a lot of concern here over their exclusion from the talks. But you heard Trump's reply to that. He said, "You've had time to sort this out yourselves. Now it's up to us to try and get a deal done." And of course, Trump's opening gambit as well to leave Ukraine's NATO membership off the table has certainly drawn a line under exactly where this conversation could go. Trump also said holding new elections in Ukraine could be a step towards peace. And of course, those comments really fueling speculation that Washington may be pressuring Kyiv to consider political changes in exchange for Western support. And of course, look, just the reality of that timeline, a wartime election is no easy task, and what leverage and political capital Zelenskyy actually has here is a big question mark at this point, considering he wasn't in Saudi Arabia, he was here in the UAE watching from the sidelines as these talks unfolded. As I said yesterday, if the Americans wanted him in the room, he would have been invited. What we've also seen is the Russian President Vladimir Putin remaining pretty silent on the specifics here. He is still expected to meet with Trump in this potential upcoming summit, but he is, it would seem, according to Lavrov, in no rush to make any concessions to the Americans or the Europeans at this point, and still holds really substantial leverage over what happens next.
Yeah, there's a lot to break down and a lot to discuss, but all I will say is I was back in Ukraine in 2014 and I remember the aftermath of Viktor Yanukovych. Why on earth would the Russians want an election in 2025? Just try those two together, ladies and gentlemen. If you don't know who Viktor Yanukovych was, have a look. Let's move on.
French President Emmanuel Macron says he will hold fresh talks to discuss Ukraine and European security tomorrow. Foreign ministers from France, Germany, Italy and the UK were briefed by Secretary of State Rubio about the US-Russia talks, with the State Department saying the group would remain in close contact.
Germany's conservative parties, the CDU and CSU bloc, have taken a dip in new YouGov polls. Just days before voters head to the ballot box, the poll showed a 2 percentage point decline for the CDU-CSU bloc from the previous week to 27%, with support for the left actually up 3 percentage points, which YouGov said was driven largely by younger voters. The AfD continues to poll strongly, coming in at 20%. Current Chancellor Olaf Scholz's SPD also actually saw a slight gain, up a percentage point on the week to 17%. Scholz will face off with the CDU's Chancellor candidate Friedrich Merz tonight in the final debate between the two ahead of Sunday's vote. And we're going to be joined later in the show by the CEO of the BDA, which is the German Employment Association, Stefan Kampeter, I beg your pardon, to discuss the election. Don't miss that conversation at 7:30 GMT. And you saw a sneak preview of our German election coverage live from Berlin. That's next Monday. That is kicking off at 6 a.m. GMT. Caro.
All right, still coming up on the show, HSBC shares touch a 20-year high as the lender embarks on a sweeping overhaul under its new CEO. We've got all the details. That's live from Hong Kong next. Plus, it's inflation day here in the UK, with investors eyeing clues on when the Bank of England will be delivering its next interest rate cut. We'll bring you that at 7 a.m. London time. And Philips reporting full year results. We'll discuss with the CEO, Roy Jacobs. That's coming up in 2 minutes. Don't go away.
HSBC is targeting $1.8 billion in cost cuts over the next 2 years amid a sweeping overhaul by the new CEO, Georges Eldry. The bank announced a further $2 billion buyback, bringing shareholder returns for the year up to nearly $27 billion after reporting annual profit above expectations. Fascinating, Emily, what's going on at HSBC at the moment. It's almost a story a week. You're on top of it. Tell us all about it.
Thanks a lot, Steve. And it's the first report card for the full year with new CEO George Al-Hedary and what he calls a strong performance, withstanding the fall in interest rates as well as a year of sweeping changes in terms of restructuring. Just in the last couple of months at the start of this year, in fact, the bank has split into 4 businesses, being more simpler as well as dynamic, splitting up into Hong Kong, UK, corporate and institutional banking, together with international wealth and premier banking. In terms of the earnings, we got a full year pre-tax profit up 6.5% to $32.3 billion. And this included a $4.8 billion gain from the disposal of its banking business in Canada. It also exited its business in Argentina. Revenue coming in flat at $65.9 billion. The bank saw net interest income fall by $3.1 billion. Its net interest margin, 1.56%, and that's a decline of 10 basis points. The bank is expecting credit impairment charges stable at $3.4 billion. The bank declaring a 4th interim dividend of 36 cents per share, and also continuing with the announcements on share buybacks amounting to $2 billion, and this to be completed in the first quarter of this year. Now, as Steve had mentioned, it is aiming for cost reductions of $300 million this year, and then an annualized reduction of $1.5 billion in its cost base by the end of 2026. It's also targeting mid-teens return on average tangible equity for each of the 3 years ending in 2027. Now, in terms of its outlook, the bank says that the global economic outlook remains uncertain, with downside risks from trade frictions and supply chain disruptions. As far as interest rates are concerned, that is expected to remain volatile and uncertain in the near term. HSBC is marking its 160th anniversary this year and says that the objectives in creating the bank to facilitate local and international trade connecting East and West is as relevant today as it was in 1865. Now, its key market, its biggest market by revenue, of course, being Hong Kong. He's talking about this corridor between the Middle East and Hong Kong, which he expects to continue to grow. So HSBC shares traded in Hong Kong, we're seeing a little bit more momentum. We were up as much as 1.5%, but we've given most of that back now, sitting firm 0.7% in response to the latest report card. Back to you guys in London.
Emily, thank you so much for that. Let's get to more earnings from this side of the world. Philips has reported fourth quarter sales of 5 billion euros, slightly weaker than expected. The company is targeting comparable sales growth of between 1 and 3% this year, but flagged persistent weakness in China. It's such a pleasure to be talking to Roy Jacobs again. He's the CEO, of course, of Philips. Roy, thank you so much for your time. I know you're a busy man this morning, but Steve and I were just poring over the numbers. Talk to me in your own words about how you felt about the momentum in the fourth quarter.
Yeah, I think 2024 was a pivotal year for Philips. We returned to positive growth, and you see clearly a two-speed world where we have double-digit decline in China and strong growth of 5% actually in the rest of the world. We expanded our margins further, and also we had a very strong cash generation, which allowed us in the end also to offer now dividend to our shareholders in cash. We reduced liabilities, as you know, when we actually closed and finalized the settlement. So we've made a lot of progress on fundamentals, and that's also momentum that we take into 2025 in a more uncertain world that we all know that we're dealing with every day.
Roy, I've got to ask you about your Chinese business. Obviously, we saw that crackdown around anti-corruption last quarter. How is spending by the healthcare players holding up? Also, when it comes to personal care, the story about the weakness of the Chinese consumer, Roy, that's well telegraphed. Are you seeing a bottom here? Because based on the guidance you give for 2025, you're still seeing a lot of weakness there. Any green shoots, anything out there?
Yeah, so China for us is a when story, not an if story. So we believe it will come back. Long term, it's attractive, but we just are not certain when it's going to happen and when it's going to have that inflection point. So if you look at the consumers, indeed more subdued, and we also see that in 2025. We also are still cautious on the healthcare spending. We still see slower procurement. But as you say, we had some green shoots in December in particular, where we saw some more tender activity. Now, we have to be seen if that is being taken into the rest of the year. Now, if that would strengthen and continue to support more of the conversion into orders and sales, we will also see that coming back into the China and then the Philips numbers. But we said for sure in the first half, we see the same momentum as we have seen in the second half of 2024 continuing. And then let's see what happens in the second half.
Roy, I'm lovely to see you, by the way, my friend. I just want to come on this one more time because I'm literally just on the chapter on a book I'm reading at the moment about China and healthcare and how it can galvanise A, the economy, B, create a social safety net, and C, mean that actually the Chinese start spending money because they feel they've got a better healthcare as well. Are you seeing that at an institutional level in China that actually will support both the private and the public sector?
So we see that healthcare is very important to the Chinese. Has been for long. We all know how important and big Chinese medicine is. And also we see that there's an aging population that is rapidly growing. So actually we see the need for healthcare really increasing. That also you see in then pent-up demand that will now kind of start to build up. Ultimately, they need also the equipment to do the diagnosis. They need to have the latest CAT labs to really treat more of the stroke and cardiac issues they're having. So really see that ultimately long-term, they will have to get better care and also then invest behind that. At the same time, and that's I think still looking at the world, we also had a double-digit order intake in North America. So you see a slower China, but you see then offset in other parts of the world that actually are doing well. And we also expect that to continue. Right. And as then China comes up, the total world growth will come up.
Yeah, I see what you did there, Roy. That's a lovely pivot. Your media team, they'll love that. You pivoted to the States in the high growth area. Let's have a word about that as well, because fantastic. I hear it from a lot of great European companies. The US is going great guns. But there are clouds on the horizon. How concerned are you about tariffs and trade wars?
So tariffs, first and foremost, I think we have to think of the patient. Because ultimately we know only from shortly ago when we had the COVID crisis what it means if supply chains are broken to deliver healthcare. So for us, we really focus on how can we keep the supply chains going. Now, we have been focusing on that with executing our plan. We have been making our supply chain more robust. What we gave as part of the guidance is that we have included the current tariffs that we know exist and also have come into effect. Those are the tariffs between the US and China. Actually, in due course of the plan, we have been reducing the export from China to the US significantly. So we have that included in the guidance. Now, it's hard to speculate what will be coming beyond that. But what I can say is, A, we are very adaptive and agile in seeing when it will happen, how can we react to that, as well as we stay the course on the structural improvement, because we know healthcare is global, but delivery of healthcare is very local, and we need to cater to that also more with our setup of supply chain, and we have been working very strongly for that.
Brilliant. Right. Okay. Roy, are you being cautious? I was just looking at your fourth quarter EBITDA margin as well and looking really solid in that fourth quarter. Your outlook for 11.8% to 12.3%. I know it's an increase as well, but actually, Roy, are you lowballing me? Can you actually knock that ball out the park?
So we gave a further increase of 30 to 80 bips. So that is a solid range. And we, of course, aspire to give the best to get to the upper end of that. But I do think it's fair to say that we're also realistic, that there is a lot of uncertainty currently around the tariffs and around what could happen to the world. And that also makes that we have taken that into consideration. At the same time, we very much focus on the controllables. So we had a very strong productivity plan in action where we said in the plan period, we would do 2 billion. That plan period ends in 2025. We are now expanding that productivity plan by another 500 million. So we will do 800 million of productivity in 2025. And the reason to be so strongly after productivity is A, to secure margin, but also to really secure our innovation spend. We have been spending in 2024 another 1.7 billion behind innovation. You know, I'm very passionate about how AI can really help to deliver better healthcare. We're spending a lot behind that. We have launched new innovations like the CT5300, which has AI-based reconstruction of imaging, which has lower dose and better quality imaging. We're also working with Amazon on the cloud services, where, for example, in digital pathology, where only 10% globally is digitized. So most of the teams are still working with glasses and the material on it and have to do microscopical analysis of that. We need to digitize that. So there's a lot of opportunity also behind that, for which we need to drive the productivity.
Roy, let me just jump in here because we're coming up towards a break. But I as you talk up the merits of AI, I wonder, are we expecting too much of that and how it's going to transform the healthcare sector?
Now, we believe actually healthcare will be at the forefront of adapting AI to really help delivery of care, because it's really an urgent need. I've talked before about the crisis in healthcare. There's huge shortages in staff. We also see the pressure for sure increasing from a cost perspective. So we need to rethink how we can do it different. And with the latest technology of AI, you can tangibly do that. I gave you just an example in how we do that in imaging. We have the same in monitoring, where we really use AI to be much more predictive. So we can be ahead of a stroke or a heart attack, and therefore minimize the impact for the patient and the cost to the system. You also see actually where traditionally healthcare was maybe a bit slow in some of the adoptions of innovation, and AI is actually leading the adoption. And in many products, in all products of Philips, actually, we have AI, and many actually have already immediate impact and are used today to save time for nurses, for doctors, and therefore deliver better care to the people we serve.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekomete, weekdays on CNBC.